Good morning. A few little technical glitches at this end, but hope we're there now. Welcome to our quarterly investment update for clients. Regular viewers will know my name is Henry Gaskin, and I'm the chair of our investment committee here at SG Wealth. I hope that, like us, you are feeling a little more positive than maybe you were when we had our last call back in January, as we look forward to a more optimistic and certainly hopefully a more sociable second half of the year. Obviously, the fine weather outside helps, and I hope that, like me, you've been able to visit the hairdressers in the last week or so, which is another weight off the shoulders. So today I'm delighted to welcome Tom Stevenson as our guest speaker on our call. Tom has local roots, having been schooled here in Ipswich a little while ago. Tom is very well known as an industry voice in his role as investment director at Fidelity, where he is responsible for developing and articulating the investment views of Fidelity's personal investment operations. Tom is also regularly featured in national press, including the Telegraph, The Economist, and other publications. And Fidelity are also very well known to us and our clients, being one of our partner platform companies, helping to administer clients' accounts. And we also use a number of their funds within our in-house investment portfolios. So Tom's going to provide a helicopter view of the world today for us before narrowing his focus towards discussing the domestic UK economy in a little more depth. I'm also very happy to have my colleague Andrew Morley on the call. Andrew is one of our wealth managers here, and after Tom speaks, he and I will be following on with some of our thoughts around some of the tax planning issues we're considering for clients at present. Before I hand over to Tom, though, just a quick housekeeping point. If we do have time, there'll be the opportunity to answer some questions at the end. We'll be taking these via the Q&A function. So please type at any stage during today's presentations, and we'll come to the questions at the end if we can. If we don't have enough time, or if it's something that needs a bit more of an individual specific sort of answer, we will come back to you after the presentation if that's okay. So without further ado, I'll hand over to Tom to take you through his thoughts.
Thank you very much indeed, Henry. So let me just see if I can manage this transition. I'm going to share my screen. So let's... Okay, so I'm assuming that you can see a slide that says SG Wealth Beyond Brexit. Give me the thumbs up if you can. Yes, that's good. Excellent. Right. Good. Good morning, and thank you very much for having me today. It is nice to be visiting my old East Anglian roots, even if it's only remotely via Zoom. As Henry said, I've been an investment director at Fidelity for 13 years now, and some of you may know me better actually from my column on Mondays in the Daily Telegraph. Now, Henry's asked me to focus on the UK today, which I'm very happy to do, because I see our domestic market as being one of the more interesting in the world today. And every quarter I write an investment outlook for your counterparts at Fidelity Personal Investing, and the UK is one of my top picks in the latest issue, which was published just last week. So before I turn to the UK, I thought it might be helpful just to stand back briefly and look at the global context. So this is a pretty remarkable chart when you consider what we've been through in the past year. We're coming out of the pandemic here in the UK, I hope, but around the world there are plenty of places where they're still very much in the thick of it. But you would never know that from this chart of the global equity market. So this is the MSCI World Index, and not only does it show the amazing V-shaped recovery from the pandemic last spring, I think it also shows how shares have marched on from those pre-pandemic highs. Shares are now around 20% higher than they were at the start of last year. And in fact, the trajectory may even be steepening. It's as if the pandemic never happened. And I think, you know, no one would have predicted that a year ago. And if you want to know why shares have taken off in the way that they have, you really need look no further than these two characters here. The reason that shares are hitting new highs today is pretty simple. It's about fiscal and monetary policy. And you have to go back to the Second World War, really, before you find a comparable period in which government spending and a supportive central bank have worked together in this way to support the economy. So the Biden administration is throwing caution to the wind. The program of spending by the US government, $5 trillion so far, maybe more than $8 trillion if all the plans are passed. It's pretty much unprecedented. It's Roosevelt's New Deal. It's Lyndon Johnson's war on poverty, the building of the interstate highway network, the space race in the 1960s. You have to go back to those examples for something which is comparable. But this fiscal program, spending, is given credibility and support by the central bank run by Jerome Powell here on the right, which is determined to keep interest rates low. And they say that you should never fight the Fed. And I think that's even more true when the Fed and the government are working together in tandem as they are at the moment. Now, there's pretty much only one thing that can stop this powerful combination in its tracks, and that's inflation. Printing money on the scale that the US is doing is likely to stoke prices at some point. And unlike after the financial crisis, this stimulus is targeted at the people who are most likely to actually spend their windfalls and create inflation. That's lower income households. And, you know, after the financial crisis, money was used to bolster bank balance sheets. It didn't really get through to the real economy. It lit a fire under asset markets, shares and property. But at this time around, I think things are different. If you send checks, $1,400 to mainly lower income households, that pretty much ensures that the money will be spent, and that could be inflationary. And it's no coincidence, if you go back to the 1970s and the inflation then, that happened after that war on poverty had improved the financial position of millions of Americans. And something similar happened in China 30 years later, when globalization dragged even greater numbers of people out of the countryside and made consumers of them. And both of those events led to commodity booms. Now, as the left-hand chart here shows, the bond market is just starting to get a bit worried about inflation returning. Bond yields have moved sharply higher as investors anticipate higher interest rates may be needed in due course to stifle rising prices. But as the chart on the right-hand side here shows, we shouldn't really get this out of proportion. Yields are rising from a very low level indeed. So they are signaling the end to damaging disinflation rather, I think, than the imminent arrival of damaging inflation. So in some ways, this is quite a sweet spot for investors. And I think it's why stock markets are riding so high at the moment. So this is what things look like from an equity market perspective. Shares have risen sharply as investors have enjoyed this, what I call the hope phase of the market cycle. They're pushing valuations higher well before earnings actually arrive to justify those higher multiples. And that's why the lines here on the right-hand side of the chart are now even higher. These are the PE ratios, the valuations of shares are higher than they were during the dot-com bubble in some cases. Now, should we worry about this? I think possibly a little bit, but not too much, because valuations can come down just as quickly as they go up when earnings growth actually arrives. And that's what I call not the hope phase, but the growth phase. And we're in the middle of the first quarter earnings season at the moment. Companies are reporting on their progress in the first 3 months of the year, and expectations are very high that those profits are going to be maybe 25% higher than they were a year ago. And that growth is expected to continue throughout this year and next. And so I think these valuations may well be justified. And this is all feeding through into a pretty remarkable change in global stock markets. If you go back over the last 10 years in a slowish growth, sluggish environment ever since the financial crisis, the shares which have done well have been those companies which could demonstrate growth in earnings through bad times as well as good. And the best examples of these defensive, high quality growth shares, of course, being those technology shares that we're also familiar with, Apple and Facebook and Google and Amazon. And they've led the markets higher for many years now. And the blue line here is an index of just that type of company. The red line is the group of companies, the slower growth, more cyclical companies that really depend on a high growth in the economy in order to grow their earnings themselves. And that's not been available for many years. And there's only really been one place to be invested in the past 10 years. But if you go back to the end of last year, since the autumn, there's been a very significant change in markets. When we had the news of those COVID vaccines being unveiled and Joe Biden was elected with his plans for big spending, ever since that point, those high growth technology stocks have been eclipsed actually by smaller, more cyclical value plays, which for such a long time have played second fiddle, as we've seen. Now, we don't know how long this is going to last. In fact, in the past few weeks, growth shares have actually regained their lead. But, whether it's the growth shares or whether it's the value shares which lead, it's a really important asset allocation question for investors. Okay, so I think that's enough on the sort of general global background. Let's focus in on the UK a bit now. The first point to make about the UK is that, and it's an obvious one to us all, that we are making good progress in pulling through the pandemic. These three charts here all show different aspects of the COVID crisis. The latest period of lockdown is that grey bar on the right-hand side of each chart. And you can see the progress we've made, a fall in the number of positive tests, that's the left-hand chart, a fall in the death rate, that's the right-hand chart, and that all-important R rate, the number which indicates whether the disease is spreading or is under control, in the middle there. And all three of those charts show that here in the UK, we've really got things under control. And so I just skipped a slide there. There we go. So, here in the UK, we finally got something right after, what was a pretty flaky start to the pandemic last year. But, we've got the vaccination program underway. As a percentage of the overall population, we've vaccinated more people even than in the US. And the surge in infections in other countries, in Europe, Canada, India, of course, shows what happens when you don't get it right. We have done here. So, how's this feeding through into the UK economy? Well, it's early days yet, but the evidence is pretty compelling that I think we could see something of a boom this summer as pent-up demand is released, and the anecdotal evidence is certainly from the first week of reopening that people are really ready to move on from lockdown. And it's not just in the UK, of course. Figures this week suggest that perhaps $5 trillion worth of extra savings have been squirreled away over the past year, that money is sitting on the sidelines waiting to be spent. Here in the UK, the figure I've seen is £180 billion has been put aside by people who've been unable to spend in the way that they did before the pandemic. And that could produce an enormous boost for the economy. And you can see in the middle chart here what happened last summer when the economy did reopen after the first lockdown. You get a really strong bounce back in GDP. And I think there's no reason to think that this year is going to be any different. In fact, it could be even stronger. And on the right-hand side, you can see what happened with retail sales. Same story. When things reopen, sales bounce back really quickly. On the left-hand side there, it's not quite so clear, but you can see that consumer confidence, whether that's about the general economic outlook or people's individual financial positions, is also sharply higher. Now, the more difficult question is than this COVID bounce, which I think is going to be pretty obvious, is whether or not we will also see a Brexit bounce following the avoidance of that hard exit at the end of last year. Now, the initial evidence has not been particularly encouraging. Trade in both directions collapsed in January. 20 to 30% declines in trade with the EU. Now, in part, that reflected a boost ahead of the introduction of new red tape in January, but it's clear that there has been a real rupture as well. And I think the impact of that will take some time to assess. I mean, one thing is certain, that no one would have chosen the timing of Brexit. You know, you wouldn't choose to do it in the middle of a global pandemic, and breaking the link with our biggest trading partner in the middle of that pandemic was obviously not great timing. However, I think with these situations is things rarely turn out quite as well as we hope or as badly as we fear. And I suspect that this will be true of Brexit too. I think we'll muddle through, as we always do. We'll find new markets. We'll patch up deals with our European neighbours too, because it is in everyone's interest to find a way through this. Okay, so that's the sort of economic background. Let's just have a look at the market situation, because this is very interesting. And, you know, this is where the impact of 5 long Brexit years has really taken its toll. The UK market has become almost a pariah in that time, because overseas investors especially have looked at the UK in the context of the broad global opportunity set. And they thought, you know, do you know what? It's not even really worth my while trying to get my head around Brexit and whether it's a good idea to invest there, because there are plenty of opportunities elsewhere. But in reality, the relative performance of the UK has actually been poor for much longer than just the Brexit period. So the chart on the left here is 10 years. It compares the performance of the FTSE 100 with the S&P 500. And you can see that American shares have performed about 3 times as well as their British counterparts over that period. Now, some of the reasons are pretty well understood. We don't have the same exposure to the sectors which have done well, notably technology that I've mentioned. We've been overweighted in areas such as commodities and financials, which have done badly. And partly the outperformance of the US is justified by higher earnings growth, but partly it's not. Partly the UK has just become much cheaper than the US. And with shares trading on a multiple of earnings in the mid-teens rather than the low 20s as they are in America, that is a very significant valuation advantage for the UK. The chart on the right is even longer term. This goes back 20 years, and it's pretty shocking, really. It shows that British shares are no higher in aggregate than they were 20 years ago at the peak of the dot-com bubble. And now, obviously, the UK market offers a higher yield than many other markets. So for investors who've been able to reinvest their income, they've had a better total return than this chart might suggest. But it has not been a particularly easy journey for investors. Now, this chart tells the same story in a bit more detail. I include it because it shows the real importance of diversification. And it shows that without a crystal ball, we can be surprised by the performance of different markets. So I, for one, would not have predicted that over the last 10 years, Japanese shares, which is the red line here, have matched the performance of the US market over that 10-year period. Now, they started from a low base before the arrival of the reforming Prime Minister, Shinzo Abe, but even so, quite an unexpected outcome. I think what's not so unexpected is that the UK brings up the rear. So the UK is the green line there, down the bottom. Europe as well, I'm not surprised that Europe has done as badly as the UK, but emerging markets right down there as well. That surprised me. So what this tells me is the absolute crucial importance in your investments of having a good geographical diversification. Now, I find this chart very interesting because what this chart shows is it compares 2 different cycles. The green line and the red line are the US and the UK during the current pandemic period, and you can see the big drop and then the differing rises. The blue and the purple lines are what happened 12 years ago after the financial crisis. And very different trajectories. The recovery from the financial crisis was very long and slow, and that's because the credit crunch caused real damage to the economy in a way that this pandemic has not done. But interestingly, you know, the valuation of the UK market is really very sort of similar to how it was after the financial crisis, and I think that that's unfair. And I think that it offers the potential for catch up with that green US line in the US. One of the reasons, as I say, that the UK has lagged the US is because of the sector exposure of our market. So one of the big sector exposures of the UK market is commodities. It's a very big component of the market, given the size of stocks like Rio Tinto, BHP and Anglo American. And looking forward, I see this as being quite a reason to be excited about the UK, actually. I mentioned those commodity booms in the 1970s and the early 2000s, and how the current fiscal stimulus set up, with a focus on targeting low-income households could cause another commodity boom. And I think another element here is the massive green environmental rebuilding program that's taking place in many places around the world. And I think that is another reason to be positive on commodities, because renewable energy infrastructure, the amount of money that's going to have to be spent on wind turbines and solar and all of those things, it may be the future to a low carbon future, but in the short term, it's going to require huge investment, and it's going to require huge investment in commodities such as copper and iron ore for steel, etc. So I think that the gains that we've seen over the last 12 months, and they have been pretty significant here. I mean, the price of copper has pretty much doubled over the last 12 months. I think that's the start of something bigger and longer term in commodities, and I think that is good news as a knock-on for the UK stock market. Okay, and I'm just going to come to, I've just got one more slide here, and this is really to address a key question about asset allocation. I've sort of mentioned it already, and it's whether this economic recovery that we are undoubtedly going to experience in the months and years ahead will drive a further rotation from those defensive growth sectors to the more cyclical value sectors. That, of course, would be very good for the UK because of the sector composition of the UK market. So that's one possibility, or whether, rising costs, rising tax in terms of corporation tax will hold back profits and see those defensive growth shares come back into favour. Now, it's uncertain what the outcome is going to be. Either of those outcomes is possible, no one knows. But the great thing about investing, of course, is that you don't really have to make that call. So every year I make a number of fund picks for our investors. And two of my fund picks this year were aimed specifically at capitalizing on what I expect to be a relative recovery by the UK market. But I was unsure about this rotation and whether the rotation to value had legs or not. So I chose two very different UK funds to play this UK recovery. One of those funds I know is held in your discretionary portfolios and from which you've definitely benefited over the last 6 months. The Fidelity Special Situations Fund has bounced back sharply on the coattails of that value rotation. The other fund is a much more defensive play on the UK market. It's the UK Select Fund, the Fidelity UK Select Fund, much more growth oriented than Special Situations. And as the chart here shows, it's the red fund here, Special Sits is the blue line. It's performed pretty much in line with that more cyclical value focused fund over the long run. What's interesting, though, is that both funds have usefully outperformed the wider UK market over this period. And that, for me, shows the real power and importance of active management and stock picking. That's all I've got to say today. Thank you for listening. I'll be happy to take any questions that you have later on, I think. But for now, I am going to hand you back to Henry.
Great, thanks, Tom. That was really interesting, and glad to say that very much aligned with our own views as well. As you say, not only in some of the funds that we hold, I noticed that some of the other picks you hold elsewhere in the world, are fairly aligned with our thinking as well. But also in terms of the messages as well. So we are, as an investment management service, we are global asset allocators. So we take this view of the world as well. We very much believe in the benefits of diversification, but also trying to be a little tactical in our decision-making process as well. And we certainly took the same view as yourself as with regards to the UK, actually increasing our weighting earlier at the start of the year in anticipation of this sort of closing of this value gap and continued rotation in style. And indeed, that I'm sure that will be continuing to be at the sort of towards the top of our agendas for our investment committees going forward. So yeah, that's very interesting in terms of the economy and markets. I think we want to now move on and just talk about tax in a little bit more detail, because whilst the economic recovery is well underway, as shown on these charts, it has come at quite a cost. So yes, as these two charts you see here, the left-hand chart shows global GDP growth pre-pandemic. Obviously, the sharp drop last year as the world went into lockdown, and then the recovery since then. And then the dotted lines are the future forecasts. We can see, if you look at the top line, the green line, China was sort of the first in, obviously being the source of the outbreak. Actually, one of the smallest impacts, and the first out as well. So their economic recovery is back basically up to sort of where they were trending, beforehand. So as you said right early in the piece, Tom, it's almost as if, the disruption hasn't really impacted things. Whereas you can see the impact on other parts of the world, is still sort of more noticeable in terms of the drop of where we are. So in terms of the UK, which is the blue line on that chart, we did see a contraction in the economy last calendar year of about 10%. That's a record number, and we all probably know it would have been a much bigger number had it not been for the huge policy support that you mentioned, from the government here, as indeed we saw from governments around the world. We've seen obviously the cost of that very visibly sort of in the last quarter. We had the budget last month, and the Chancellor put the cost of the coronavirus support measures at a figure of about £344 billion, and no doubt that may well continue to increase. We had a similar story elsewhere in the world. The chart on the right-hand side there shows global government borrowing and their debt to GDP ratios, which basically have hit record highs not seen since World War II. Without deploying this monetary firepower, obviously, economies would have been completely ransacked. So it was a necessary course of action. But now the job of politicians is to set their budgets, rebalance their budgets, and get back on a more normal course of borrowing to balance the books, whilst not disrupting the economy too much further. Quite a challenge. So in the UK, we had the sort of first step towards this with the budget, as I said last month. There weren't any sort of hugely significant new tax or fiscal measures introduced, but there were certainly many revenue raising announcements made by the Chancellor, which will affect businesses and individuals. We are covering this in our Vision magazine for clients, which I believe should be being sent out in the next week or so. So look out for that on your doormat soon. But for now, myself and Andrew are just going to cover some of the key announcements around personal taxation. As the picture there suggests, what the Chancellor did was on personal taxation was cast a big freeze over UK tax allowances, which was quite a subtle way of raising tax receipts, but actually quite a significant way of raising tax receipts over the years to come. We're also going to comment on that and the potential impact of that, but also comment on how we can apply a little bit of SG Wealth financial planning anti-freeze to the measures that have been introduced. So I'd now like to sort of just hand over to Andrew to consider, in the first instance, the impact on income tax.
Thanks, Henry. Morning, everybody. Yeah, you can see the slide that we've just sort of put up there, and I sort of going back to the budget sort of in spring this year that was announced. This year's budget, what we saw was the income tax thresholds were largely unchanged. There was a small increase in personal allowance and basic rate tax paid band based on sort of inflation back in September last year, which was below 1%. I think the main point to note is that, as Henry alluded to, the rates are now frozen until tax year 2025-26. So what's going to happen is it's going to mean a position where more people are going to get caught by increased tax payments over this period. And with that, the government expects to receive an additional sort of £8.2 billion of tax revenue over that time. So the chart there shows how the budget has changed the different taxable income thresholds, although the additional rate threshold at the 45% continues to sort of kick in at £150,000. And you'll also notice as well that the highest rate of income tax is paid at between the 100,000 and 125,140 bracket, which has an effective rate of 60%. This is down to the fact that an individual loses £1 of personal allowance, so the 12,570 for every £2 of income received above the £100,000, and therefore beyond the 125,140, an individual loses the personal allowance in full. We're going to move on to sort of a next slide, which shows how sort of certain things can help, as Henry mentioned, sort of trying to show how antifreeze can kick in and how pension contributions can potentially help reduce some of the tax burden. So, as I said, making pension contributions can help reduce the tax burden in a number of ways for individuals, especially those caught in the higher and additional rate tax bands, as tax relief can be claimed at marginal rates up to the 45% allowances, so can be quite effective in tax planning. It can also help to recover some personal allowance, so where earnings are between the 100 and 125,140, it can actually help to recover some of the personal allowances by effective planning, in which case then providing sort of the highest level of tax relief at a rate of 60%. Also, you have to consider that by making pension contributions, if you're able to claim 40 or 45% tax relief or get back some of your personal allowance whilst working, with careful management and advice at retirement, you're could be in a position where you're actually paying a lower level of tax, even down to basic rate of 20%, or as we may come on to later on, even actually paying zero tax in some respects. So tax relief for 40-45% going in could effectively mean a tax rate of 20% or lower at the point of retirement. In terms of putting in contributions, the general rule is you currently have an annual allowance of 100% of earnings up to £40,000. If you've not maximised contributions in previous 3 tax years, you can utilise those so long as your earnings are in excess of £40,000 or your employer is happy to make a contribution on your behalf. Sometimes that's good planning for sort of company directors in terms of sort of moving money out of the business and gaining benefits from a personal point of view later on. There are also some contribution restrictions though for higher earners. So again, you know, people are limited into what they can do at certain points. So where earnings from all sources exceed sort of 240,000, and when I say all sources, that's not just sort of income. So if, again, talking about company directors, if you have a mix of dividends, salaries, rental income, other income that comes in and that exceeds 240,000, then effectively you start to lose some of that annual allowance of £40,000. Once income goes above £312,000, then an individual has an annual allowance that's reduced down to the minimum level of £4,000. So it can also be reduced if you also start to draw income from a money purchase pension. And believe me, I've seen that happen in the past where people have taken their own advice and looked at drawing pension schemes and ended up not realising how much that actually impacts other contributions that they can actually make. There also, you know, can be considerations made around lifetime allowance, which Henry will cover in due course. But one final note is to make sure that tax relief is claimed. There was a figure sort of come out recently to say that a number of people don't make the claim to claim the additional tax relief that they're available where they're 40-45% tax bands. You have individuals that when you put money into a pension contribution, you get 20% tax relief straight away, and then the rest of the tax relief on the 40-45% bands then has to be claimed via self-assessment. So just remember to do that. That's useful in that respect. And what we're going to do now is look, you know, beyond that and just look at, you know, when people can actually draw the pensions, or draw income at retirement, what it is that can actually be achieved in terms of creating tax efficient income. So pension contributions can make a difference to an individual's tax position whilst working, and maybe even beyond retirement, and form an important part of planning for that event. And at some point, we'd all like to take the opportunity to consider retirement. And this slide shows how income can be drawn tax efficiently using the available tax-free allowances that we have in our armory to be able to do that. So you'll see there are a number of allowances available, and it's important for us to consider this when we're putting a retirement plan together for individuals. On that basis, individual circumstances are different. Not all of the allowances will apply to everybody. This example shows how a net income of 54,127 can be achieved if we're able to work with a blank canvas at the point of retirement, but also utilising things like pension, tax-free cash, and also ISAs as well. If those options aren't available, then you still have a potential income of 34,127 available to draw tax-free from a variety of sources. As a couple, then that gives potentially tax-free income of anything up to sort of 68,000 plus a year that can be drawn by us making use of those allowances with effective tax planning. So covering those slides quickly, then I'll now pass back to Henry, who'll look at also other planning areas as well.
Thanks, Andrew. Yeah, the last slide just shows how valuable those tax allowances can be. I was trying to work out what we'd need to have in terms of gross income to generate sort of 54,000 in net terms, just from pensions. And I think, you need a gross income of, getting towards £70,000. So, with that sort of careful tax planning and, preparation for sort of retirement in terms of making sure assets are held in the right tax wrappers and in the right way, potentially there's a scope to save, nearly 15,000 a year in tax, which obviously over multi-decades can be very, very significant. I just want to cover another allowance, which is very important. And again, the Chancellor has frozen for the next 5 years. That's the lifetime allowance. And this is actually one of the most challenging taxes to plan around, because basically decisions you make sort of 1 year, really, the impact of them when it comes to the lifetime allowance are often not felt until sort of many, many years to come in the future. So just as a reminder, the lifetime allowance was designed as a lifetime limit on the amount of tax relief a person can receive, although it's not really the case, because the allowance is based on the pension fund at the point you draw your pensions in retirement, which includes the investment growth that they achieve, which potentially, as I say, can be over multiple decades, rather than actually the amount of the pension input at the time of the contributions that the tax relief has really been given on. So it is a challenge, as I say, and it's an allowance that the Treasury have played around with quite a lot over recent years. So the lifetime allowance was introduced in 2006 at a starting level of £1.5 million. And since then, it originally ratcheted up to a level of £1.8 million. Before then, through austerity measures, it was cut back down to £1.5 million in 2012, and then cut again in 2014 and 2016 down to 1.25 and again 1 million. So quite a significant, or very significant drop from 1.8 down to 1 million. Since 2018, it started to sort of creep up again in line with CPI. But again, in March, the Chancellor said, no, that's not going to happen for the next 5 years. CPI was only been a 0.5% increase this year, but as Tom said earlier, the spectre is that inflation may well start to sort of to rise, and those inflationary increases will hurt, or the loss of those increases will hurt over the next few years. The Office of Budget Responsibility expects that through their own forecasts, the lack of that indexation is going to impact the lifetime allowance to the tune of about £85,000 over that period of time, which means that for those people who might have larger funds, this could generate about, well, over £21,000 of additional lifetime allowance charges per pension fund. And furthermore, because you're only allowed to take up to 25% of your lifetime allowance as tax-free cash, if the lifetime allowance is lower, less of that allowance can be taken tax-free, and more of your pension fund will pay income tax as well. So actually the cost to individuals with larger pension funds is higher than that £21,000. So there is a challenge to sort of add, some efficiency and value by getting the lifetime allowance right. So our blue antifreeze again, it's a bit tricky to deal with, to be honest, with regards to lifetime allowance. It is a very complex area, and getting it right or wrong can be very significant. There's no really sort of clear-cut strategy, because it very much how one handles a lifetime allowance is very much dependent on the personal circumstances. It's based on your income, your assets, your much broader assets as well. It interacts with things like estate planning and inheritance tax planning, and your needs in retirement. How much income you might take from your pension in retirement and things very much has an impact on the lifetime allowance as well, because not only is the lifetime allowance a test that comes into play when you draw on your pension benefits, whether that is before you retire, when you retire, or after you retire. There's also secondary lifetime allowance charges and tests at age 75 to consider as well. So it is a complex area. It's one that we feel, though, that we can add a lot of value to clients with, because we are very experienced. We have a lot of knowledge, in-house, and it is an area we really sort of can look at quite forensically for clients. Getting the timing right of when you draw benefits is important. As I say, it doesn't have to be just when you retire or stop work. Often it's either sooner or later is the right answer. Also, considering the order of which people's pensions are drawn is very important. The lifetime allowance is assessed differently if you have a money purchase fund like a SIP than it is if you have a defined benefit plan like a final salary plan, where they use a multiple of your annual pension of 20 times to test against the lifetime allowance. So there's a lot of complexity there. We do a lot of work around this, and obviously the freezing of the lifetime allowance is going to make the value of that work even more important in years to come. Another sort of similar area where we do sort of other complex work and where we can add a lot of value is estate planning. So I'm just going to hand back to Andrew just to sort of cover off some thoughts on that as well.
Yeah, thanks, Henry. Another allowance that's being frozen is the inheritance tax allowance. The idea was that would be increasing with inflation within the next sort of few tax years. But again, that's now been held at the level of 325,000 again until 2025-2026. This has been at this level since back in 2009. We have had some uplift, which has been achieved by the introduction of the residence nil rate band, which currently stands at sort of £175,000 individually. This potentially provides a combined individual nil rate allowance of £500,000. Just have to be mindful that residence nil rate band is available to use against an estate value where the deceased owns a property and the property is passed directly to what is termed as lineal descendants. So for example, children. For a couple, any used nil rate bands can be transferred across to the surviving partner, potentially giving an inheritance tax-free estate value of £1 million. Just in regards to sort of excesses, so any excess above the available nil rate bands. So for example, if an estate is worth £1.5 million and there's a £500,000 excess, then at 40%, that's a tax liability of sort of £200,000. From this, the government expects to raise an additional 1 billion over the next 5 years because of rising estate values. We're already seeing sort of inheritance tax revenue increasing over the last few years, and that looks set to rise with the fact that these allowances are being frozen. So again, the next slide will sort of give us some idea of maybe how we can deal with that and mitigate some of the inheritance tax that may be liable on estates. The first thing to say is that we've got pension funding. Pension funding is a great way of being able to sort of move money into an estate without, at the moment, under current legislation, actually providing any value against the estate. Obviously, that could change in the future, but apart from getting the tax savings from the tax relief that you get on the contributions, there's also at the moment a good inheritance tax saving as well. As we go through, you can see individuals, you can use sort of gifting. So in general, there's annual exemptions that can be made. So for example, the £3,000 per annum gift to children that can be utilised. If that as a couple, then that can be £6,000 a year. And if it's not been used in the previous year, then £12,000 can be passed across to children from that point of view. You can have unlimited gifts of £250 that you can give to others. There's also other gifts that you can consider in terms of in regards to sort of weddings and by grandparents and parents as well. So there's other allowances that we could utilise and help advise on. The other thing as well is individuals can also use gifts out of income rule. This is one that is not as commonly used as it could be. So where any surplus income is available, it can be gifted and falls outside of an estate. For any form of gifting, it's always important that you keep very, very good records, because the one thing that you don't want happening is the revenue challenging any of the gifts when the estate's being dealt with, as it's fairly difficult time as it is at that point. Also, in terms of what you can do, you can use different types of trusts to reduce the estate value over a period of time. So the type of trust and product required will depend on any requirement to have access to income, capital, or a combination of both, and how those are set up. Generally in trusts, you have a period where the assets will fall out of the estate sort of in 7 years or more. But there are also other options available to people where they can get inheritance tax relief a lot sooner, using the current business relief rules that apply, whereby the assets fall outside the estate after a 2-year period. We just have to be mindful of the fact that some of these investments then can be subject to sort of a higher level of risk, and it may not suit everybody's sort of profile with regards to those types of investments. So they have to be considered very carefully. And finally, if individuals do not wish to consider any of the above, retain assets for their own use, insurance policies can be an effective way of helping towards any inheritance tax liability. You will effectively use a life insurance plan, usually whole of life, written in trust, with the benefits paid upon death, so that the family can pay any liability either in part or fully, because there's no guarantee that either, if inheritance tax has increased, it may be that there's a shortfall which would need to be met by the estate. If any surplus is then it comes from the life insurance policy, that can be retained for distribution to beneficiaries. So there's plenty of planning there that we can get involved in terms of helping to sort of mitigate some of the potential liabilities that people would get from inheritance tax. So I hope what we've done is given you some ideas around the tax savings following the budget. And what I'll do now is pass you back to Henry to sort of close the meeting and go through any questions that people have.
Great stuff. Yeah, thanks, Andrew. Just on estate planning and inheritance tax, yeah, I mean, that was a very, very high level sort of shopping list of sort of mitigation sort of strategies there, which clearly requires an awful lot of detailed planning and things that we can help with. We are actually intending to run a estate planning and inheritance tax webinar, which you may wish to join us on. That'll be in June, so look out in your mailboxes for invitations and further information on that in due course. So yeah, as Andrew said, that's sort of about the end of the structured presentations. We will be taking questions. I've got a few in already, but yeah, just like to encourage everyone else, if you'd like to sort of raise any questions for us, or particularly Tom, because obviously you can ask us at any time and we'll come back to you. But obviously Tom's with us today, so I'm sure we'll be happy to answer any questions you've got. Please just use the Q&A function in Zoom just to put any questions in there, and we'll pick them up as they come in. But yeah, I've just got one final slide before we go on to questions, just to show you. It's the one we sort of show every quarter anyway. And it's just our usual sort of reminder about the longer term nature of investments, because I think as last year taught us, you know, as ever, we should be expecting the unexpected when it comes to investments. However, you know, whilst we know that markets can go down as well as up, you know, and we know that the risk of that is not suitable for everyone, or indeed every part of everyone's wealth. This long-term chart does show that, you know, if you can embrace the volatility in markets, you know, it should provide you with greater returns to your capital over the longer term. No guarantees, of course, but the longer the course is, the higher the likelihood is that you'll be able to enjoy decent sort of risk-adjusted returns, which is obviously what we're aiming to deliver with our investment portfolios. So yes, if you've got any questions about the performance and risk positioning and portfolios, yes, please speak to your advisors and your usual contacts. And yes, I will just take a couple of questions now, if we may. I think we've got a little bit of time. So could I ask you, Tom? We've had a question in talking about the UK. We've had a question in with regards to Scotland. I guess with the local elections looming next month, whether that might put any pressure on towards sort of a second independence referendum, and if that were the case, what are your thoughts around that and what the impact on that could be?
Yes, I mean, yeah, I mean, I think this is so the election that's coming up just after the bank holiday is a really important one regarding Scottish independence, because what's happened is that Scottish independence and Brexit have kind of been sort of tied together in people's minds, and it's really sort of focused attention on the independence question. And indeed, opinion polls on Scottish independence are showing a majority in favour of independence, and there's been a whole series of these, and it's been, you know, the longest series of positives for it that there's ever been. So clearly that's only going to happen if the SNP get a majority in Holyrood, and you know, they're leading a minority government at the moment, and all the other main parties, Conservatives, Labour, Liberals, are opposed to a second referendum. But you know, the question is, you know, does Brexit mean that Scotland is better off on its own, or does Brexit mean that even more so Scotland is stronger within a united UK? So you know, it's clearly very important. Nicola Sturgeon has said that if they do get a majority, then she will be pushing for a referendum in the first half of the next 5-year parliament, so pretty soon. And it's, at the moment, the opinion polls are suggesting that it may go towards independence. From an economic perspective, it is slightly hard to see how that could be of benefit to Scotland, or indeed to the UK. But, you know, as we discovered with the Brexit vote, this is not principally an economic argument. This is a sovereignty argument, and so I think it's very hard to predict. I think that it would be a negative from a market perspective in the short term. Whether it would have a longer term impact, I'm not so sure.
Okay, well that's interesting. Yeah, so a bit of outlying risk there to weigh up when we're looking at sort of UK and sort of the impact. Yeah. But yeah, as ever with anything political, it's very difficult, as you say, to sort of make predictions with any sort of conviction. You know, again, that's we've learned that over the last few years for sure.
Yeah, absolutely.
We've had another question through UK centric wise as well. Around not equities, but a different asset class, property. I guess sort of on the back of you know, how the world is emerging out of the pandemic and lockdowns, and you know how that might change and influence things, and whether you have any thoughts on the sort of the real estate market at all.
Yeah,
probably more. Yeah, commercial minded, I guess, from an investment perspective, more so than residential.
Yeah, I mean, it's the commercial property market is very interesting at the moment, because there there's clearly a sort of two-way pull going on here. That on the one hand, in a low interest rate environment, which, you know, frankly, we are going to remain in for the foreseeable future, then the yields which are available from commercial property, even with the weight of money that's gone into commercial property in recent years, pushing yields down, even so, the yields are still relatively attractive. I mean, if you can get a sustainable yield of 3.5–4%, then that's pretty attractive in a low interest rate world. The counter argument to that, of course, is that the world in which commercial property operates has changed enormously over the last 12 months. So whether you're looking at offices, you know, look at us, we're all sitting at home. And, you know, while we may be looking forward to getting back into the office in some form, it's unlikely that we are going to go back to the office full time. And, you know, that is going to change the demand for office space and the nature of office space and the location of office space as well. So that's interesting. And then you've got retail. And, you know, clearly one of the big impacts of the pandemic has been an increase in online retail and real problems for town centre bricks and mortar retail, and that has been reflected in valuations as well, particularly in the UK, where the economy is skewed towards the capital, where the sort of transport issues are more pressing than maybe in some other countries. So I think that commercial property as a diversifier in the portfolio still has a real benefit. It has a yield attraction, and managed well with a view on this changing dynamic of you know, in offices and retail in particular, and the rise of logistics, because of course the flip side of online retail is that you need a lot of storage and warehouses and that kind of thing. So there's a real pressure on commercial real estate managers to manage their portfolios in a very active way. And the ones that do it well, there are plenty of opportunities, because, you know, the world is changing, and if you can ride those changes, then all to the good. So it's a very interesting area, I think.
Yeah. I think we share similar sort of views. Really, we've held property assets, both UK and overseas, and other real estate infrastructure assets in the portfolios for some time. And yes, that appeal, as you say, for sort of an income-based sort of return still persists. We have had, I think it's maybe just worth saying for some clients, we've always taken a view whereby, you know, we will have a diversified exposure to the asset class. So we'll have some real estate assets which are sort of listed, so they are behaving in a bit more of a volatile way, a bit like equities. And in some cases, we've also had some exposure to sort of physical property funds, where the fund will actually own physical units and buildings. Now we have had some liquidity challenges with that side of things over the last 12 months, but that's not something that as investors we were sort of unaware of, sort of as a risk. Indeed, that's why we hold that diversified exposure to assets and a limited exposure to those sort of assets within our portfolios. It has been pleasing to note that a lot of the well-managed funds that you say, you know, have ridden out sort of the uncertainty of lockdowns and now have started to open up their funds, some a little more quickly than others. Yeah, we are in constant contact with all of our fund management groups that we hold, whether it is property, equities, bonds, or any other asset class. We had the notes this week actually from M&G, who we don't hold within our portfolios. They are one of the largest physical property funds in the UK that and I think they were particularly challenged with retail exposure actually, and they're actually announcing the opening up of their fund in early May. So I think there is there's certainly liquidity in the UK property market to enable them to do that, to sell properties and raise it, because there is still that demand for that income. So yeah, I'd agree. It's an interesting asset class, and still forms a part of the investment sort of universe, I think, for us. And I guess one final question we've had, because I know we've just ticked over 11:30, but I'd just like to get your views, if we may, on another part of the investment universe that one often puts into a well-diversified portfolio. Going back to your first point in your presentation around the rising risk of inflation, one asset class that tends to sort of suffer in that event is obviously bonds, whether they're government bonds or to a lesser extent sort of maybe some corporate fixed interest assets. One question we had through was sort of if we do anticipate building inflation, what is the point in holding bonds in a portfolio? And I think I'd very much have a view on that, and would point to the diversification benefits of events, things like last year and volatility in equity markets. But again, you probably could elaborate on that a little bit, Tom, maybe.
Yeah, absolutely. I'd agree with that. I think that we should not underestimate the diversification benefits of some fixed income within a portfolio. And indeed, while the income attractions of bonds are not immediately obvious at that moment, having seen yields rising, they are starting to look interesting from an income perspective as well. So a 30-year US Treasury bond is yielding 2.3% at the moment. Now, okay, in historical terms, that's not very high, but with interest rates on the floor, it is a real and a reliable and a safe income, and indeed, the difference between 2.3 and 0 is reasonably large, and it does offer the potential for, if things don't turn out quite as good as we expect, then it does allow the possibility for some capital gain if yields do come back down again. And indeed, we have seen just in the last month or so that those 10-year Treasury yields, which went up to 1.75%, have come back down to 1.55%. So yeah, I mean, I think I have been fairly negative on bonds in the past. I think at current levels I'm less negative than maybe I was.
Good. Yeah. Good. Thanks. Well, thanks for your time. I think we have run over a little bit, so I think we better draw things to a close there. So yeah, thanks again, Tom, for joining us. Thanks to everyone on the call for listening in. I'm sure you found it very interesting. Please provide some feedback to all of our panelists via the completion of your feedback questionnaire you'll be sent after the meeting. As I say, also look out for our webinar on estate planning in June, and we look forward to our next investment webinar as well in July also. So yes, final thanks to everyone for joining us. Hope you all enjoy the rest of your day and make some use of the nice sunny weather out there, and look forward to seeing you again soon. Many thanks.